Hello everyone, welcome back to my channel. Today I want to talk about two futures trades that I recently made, one on the short side of the market and one on the long side. In this video I'm going to start with the short entry, so make sure to stick around if you want to learn till the end. As always, I'll be sharing my thought process behind each trade and show you how I do analyze the markets to make well-informed decisions. And when it comes to this part, the well-informed decisions part, obviously this thing doesn't work all the time, as we all know, because even with careful planning, some trades will still go against us no matter our level of analytical skills. However, I do believe that traders who are methodical in planning and managing risks tend to earn higher rewards. Market timing, learning from your mistakes, and trade management are clearly, in my view, important factors to remember or to bear in mind when it comes to trading. Alright, with that said, let's now start with trade number one. So if we take a close look at the 1 minute chart here, we can identify several important factors that are worth considering for a short entry. The first factor is that the price seems to be overextended based on Fibonacci's retracements. Obviously, this indicates that the market is overbought, with buyers pushing prices beyond their fair market value. For those new to day trading, when prices are pushed beyond their fair market value, it basically means that the market becomes inflated and can create an imbalance between supply and demand, or buyers and sellers. This can then lead, not all the time, but it usually works this way. This will eventually lead to a form of a pullback or a price reversion. Secondly, and as the chart shows, it is clear that there is a notable difference in the speed and magnitude of the current trading range compared to the previous range. Furthermore, it's worth noting that the current upward trend appears to be gaining strength here, while the trade volume is decreasing. This potentially suggests a bearish momentum that could quickly turn into a correction and possibly a quick scalping trade for me. Another important technical aspect I want to bring to your attention too is that after the market reached an intraday high above the 44.22 level, it changed direction, moving downward. This caused a break in market structure, or market formation is the same thing, at the 44.15 level. What that means is that now we have an increased likelihood of a temporary price reversion. In other words, a price will now have a higher tendency to revert to its mean or average value after deviating from it for the last hour or so. I think, guys, that the most important thing to understand in this portion of trading is the combination of a decrease in trading volume and a change in the market's formation. The reason I'm pointing this out is because when the trading volume decreases, it's often seen as a sign that the market is losing momentum and liquidity, which can lead to a decrease in demand for that specific asset. Additionally, when there is a change in the market structure, meaning the price action and chart patterns shift, this confluence can indicate a shift in balance between supply and demand, which can eventually then lead to a change in the market's direction. Therefore, it's crucial, I think, to observe both trading volume and market formation simultaneously, obviously, to get a better understanding of the market dynamics. It is important to note here, guys, that while a decrease in trading volume alone can suggest a lack of market participation, this may not always signal a change in the market's trend or direction. Similarly, a shift in the market structure without a corresponding decrease or increase in trading volume may not necessarily signal a significant price movement. However, when both factors are present, it's important to take notice and analyze the market carefully for potential trades. So the combination of all these technical elements I just mentioned led me to enter a short just above the 44.16 level. And as you can see in the chart, the first part of the trade went smoothly, but the second part proved to be honestly a bitch. And let me explain. Now, one of the reasons I lowered my stop loss at this particular level up here is because I believe that if an upward attempt began, it would likely end once this large imbalance area was balanced out. My reasoning was that after this balancing act, the market would resume what I assumed it to be a bearish bias. I think this was a realistic expectation on my part, given that markets tend to follow trends, and that if there was a bearish bias before the balancing move, then it's likely that the market will continue on that path. Well, it didn't work out that way at all. I got stopped out on the second contract because I was totally wrong in thinking that the market was experiencing a bearish trend when this was actually just a temporary pullback. And I want to explain why I made this mistake so that you can avoid it in the future. Obviously, I made an amateurish mistake before entering the trade, in the sense that I usually make sure that the higher and lower time frames are in sync before my entries. But this time, because I rushed to enter the trade, I failed to look at the price action at a higher time frame. So I only analyzed the 1 minute chart. And honestly, I don't know why I missed the big picture here, but I must have probably spaced out or something to make such a dumbass move. No harm though, because I still ended up green on the entry, but still, these mistakes can be costly and shouldn't happen. If I had taken the time to look at the 5 minute time frame and remembered one of the main rules in day trading, that the fractal nature of price means that what appears to be a distribution phase on one time frame may actually be a trend on another time frame. So had I included this factor in this trades analysis, I would have figured out that the trend was moving upward and that the market short bias in this particular range was just a temporary pullback before the next leg higher. So bottom line, this is where I screwed up on this counter trend trade. That said though, remember guys, trading is a process, and good traders are not defined by a single mistake or mistakes, but rather by their ability to keep records on their mistakes and learn from them. This eventually results in regularly executing profitable trades in the long run. So the idea is, don't get discouraged by your mistakes or losses. Instead, keep your focus on improving your skills and refining your risk management and strategy. With practice and discipline, you'll become a more successful trader over time. With this trade complete, let's now move on to the second trade, which, as you guessed, will be a long entry. So we are back at looking at our 1 minute chart. As you can see, the price movement is similar to the short trade I just analyzed, except for this range extension up here. Now I'm going to place a long order here above the 44.19 level. Obviously, there are several reasons behind this decision. Firstly, there is a clear formation of a bullish reversal hammer pattern down here on strong value. Additionally, and this in my opinion is another high probability technical factor, up here we see prices moving sideways on low value. Usually, I think that such a move indicates a consolidation phase rather than downward pressure, which increases the likelihood of an upward trend. Next, there is another phase of low volume accumulation. However, this time the price experiences a significant retracement to the downside. And this pullback and retest above the 44.19 level marks my intended entry point. Now, it's possible that the retracement to the downside is due to manipulation, but it could also mean that traders who bought the market at a lower price are cashing in on their profits. Nevertheless, the drop that followed further confirmed my decision to enter. If you look closely, this drop is not as severe as the initial retracement, which suggests to me that there is less significant progress in terms of material prices. Also, it looks like the market is finding support above the 44.19 level. This suggests that this level could be a key support area defined by previous price action, which has a potential to act as a floor for the market's next move higher. Again here, if the market stays above this level, it may signal that buyers are gaining control over the supply side. This in turn could lead to a breakout to the upside, where the market moves well beyond its previous intraday high. If this scenario occurs, it presents, I think, a favorable opportunity for me for a long and high probability trade. However, and as I previously mentioned in this video, it is important to note that technical analysis is not an exact science, and there are no guarantees that the market will behave as expected. That's why you should always be prepared for unexpected price movements and use risk management to minimize your potential losses. Luckily, my analysis was correct this time about the trade, as the market clearly continued to rise, reaching both of my profit targets. In conclusion, guys, succeeding in trading involves having knowledge, patience, and obviously a bit of luck. It's important to keep in mind that despite having the best analysis, the market can and still be unpredictable and experience sudden changes. Therefore, sticking to a risk strategy in your trading approach is crucial for success. Alright gang, that concludes this video for today. If you like the content, I'd appreciate you taking 2 seconds of your time to leave a like and subscribe. Thanks for watching, and I'll catch you all in the next one.